Good day, Market Chameleons and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the share disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. One last look at the disclaimer, and let's welcome Dimitri Pargamonik to the stage, who's going to talk about how to analyze implied volatility term structure with visual graphs. With that, welcome, Dimitri.
Good morning, Will. How are you?
Great.
So let me share my screen here, and we'll go look at an example of how do we compare implied volatilities in a stock, in a security, along different maturities, because the implied volatilities in one expiration could be different than a different expiration. You could have a short dated expiration, let's say 30 days, where you have implied volatility, but if you go out 60 days, the implied volatility could be higher or lower. You go out 90 days, it could be higher or lower than that. And what we want to do is take a look at the differences between them and see how those differences compare to each other over time. So let's use an example here, and I'm just going to go to Google, for example. So I'm going to type in Google into our search. This will take us to Google's main summary page. And on the left-hand side, we have volatility. Let's click on that. And what we're going to do is actually we'll look at it from two different perspectives. So we'll use two different tools. First, let's do the implied volatility. So when we go to this implied volatility page, I'm going to click on the menu to minimize and expand our screen. We have initially this graph, and you see a 30-day IV. This is a historical 30-day implied volatility chart. And so this is looking at a constant maturity, 30-day constant maturity implied volatility, and at the money implied volatility. If I click on this term structure, now it gives me four different charts. It gives me the 30-day constant maturity, 60-day, 90-day, 120. So by looking at all these lines on the same chart, what we could do is kind of visualize how they changed over time and how they also change in relation to each other, right? Where did they all go up? Did they all go down? Was there a correlation, and how did they move relative to each other? So let's remove some of these. We have four lines here. Like, for example, with the 30-day, 60-day, 90-day, 120. What if we just remove the 90-day and 120 by clicking on it? So now we have a chart of the 30-day implied volatility and the 60-day implied volatility. And we could see over time how they changed and how they moved in relationship to each other. So you kind of tell that there's correlation where they they'll go up together, down together, but it's not a straight correlation, one for one. There's variance there, and just eyeballing it, we could see that the 30-day, which is in this dark green line, fluctuates above and below the 60-day red line. So they're not exactly moving, in sync. It crosses over. So we could tell just by eyeballing it here that sometimes you'll have the 30-day implied volatility go above the 60-day. Sometimes the 30-day implied volatility is trading below the 60-day. And sometimes they're very close together. Like right now, they seem closer together than other times in history where we've seen them diverge from each other. So this is creating a visual for us of the implied volatility based on maturity, right, relative to each other. I'm going to go to, and you can do the same thing, if you want to compare 90 versus 30 days or 120 days versus 30 days, for example, we could just kind of quickly visualize that. If we want to see the differences, because here we kind of just are eyeballing what they look like relative to each other, what if we wanted to see the historical differences? What is the difference in the implied volatility of the 30-day versus the 60 days? Are they, one vol click apart, two vol clicks, three vol clicks? So we could click on this difference, and this difference gives us a chart of, over here we have the 60-day minus the 30-day IV, the 90-day minus the 30, the 120 minus the 30. So these are all relative to the 30. So let's just uncheck two of them. And now we have this orange line here. And this orange line shows us the difference of the 60-day at the money implied volatility minus the 30-day implied volatility. So if they're both the same, the difference is zero, right? If they're both, let's say, 20, then 20 minus 20 is 0. If the 60-day is higher than the 30, let's say 60 days 22 implied vol, the 30 is 20. So 22 minus 20, the difference is a positive 2. And the other way. So here we could see how the difference between the two implied volatilities look like over time. So you could see it's moving, moves above and below 0. Sometimes, like the other chart showed us, there are times where the 30-day was above the 60-day, sometimes below. That's why we're seeing it move above and below 0. And it kind of also shows us the highest, divergence from each other to the upside and downside. So if we look at it from the perspective of, here we have a 5.8 difference, 6.6 for positive 6.7. So we could see that, on the high end, the 60-day implied volatility was as high as 6.7 vol clicks above the 30-day. On the other side, if we look at the negatives, we got, as much as 8% down here. Sorry, minus 5.9%. We could just go in there 5.6. So this gives us a sense of, well, how much did the 30-day IV, go above the 60-day, or the 60-day below the 30-day. And the idea here is that if we're looking at the term structure and we just wanted to get a quick assessment where we are right now. So you can see here right now, the 60-day, right, is below the 30-day by 1.7 clicks. Right, so that's the 60 days trading below the 30-day, 1.7. But historically, we've seen that they've diverged by much more. This is now getting closer to the 0 point, and it allows us to make that quick visual, assessment analysis of that term structure, the differences between the longer dated and shorter dated maturities. One other quick way to do it, if we wanted to change up some of these and look at the differences by selecting maybe like more of a custom selection. So I'm going to go over here, click on this menu, and we're going to click on risk premiums here. So when you click on the risk premiums, you come to this page where it defaults to a chart. So the 30-day at the money over here, just like we were talking about. But let's say we wanted to compare a 30-day at the money to compare it to something else. Like let's say we wanted to compare it to a 90-day and maturity, and we wanted to look at a out of the money put. So let's just say 10% out of the money put. So this is, instead of an at the money, we're looking at a put, but it's a 90-day constant maturity, 10% out of the money put. Okay, so then we could look at those differences and reload the chart, and now we see the difference, okay, of the 30-day at the money minus the 90-day 10% out of the money put. Okay, so this green line over here is looking at the daily differences. Okay, 30-day at the money minus the 90-day out of the money, and is doing it in percentage of spot price. Okay, so this is looking at the premium of the options. This orange dotted line, okay, shows us the average of all these differences. So the idea is, here's the average of all of them, and how far away do we deviate from that average? Okay, is it always near the average, which would suggest that, you know, the relationship is constant over time, right? It's just that if this line is right at the average all the time, or if the differences move around, could move around a lot over time around that average. So that's a quick visual of looking at implied volatilities relative to each other if we using different maturities, different option maturities. Well, I'm going to stop there and throw it back to you.
Great job, D. And everyone that was using Google, and I'll put a link to where you can get this on the YouTube video for anyone who wasn't there at the start when D slid to it. D, could you just show them how you got to this again? Well, I know we had someone coming in and he asked about it. How you got to this screen?
So if you're on the main page, and on the left-hand side, you have a menu under volatility, go to risk premium, and then you'll end up on this page.
All right. Perfect job, D. Thanks for bringing these webinars to the Chameleon community and everyone who joins through the links. You have a great day, my friend, and we will see you tomorrow for the end of the week morning webinar.
Yep. Thanks, everyone, for joining. Stay safe out there. Have a great trading day, and hope to see you tomorrow.
Thanks, D. We'll see you tomorrow, buddy. All right, everyone. Thanks for joining. Remember to follow us on all the social platforms. If you're on YouTube now, remember, thumbs up, always appreciated. If you're joining for the first time and haven't taken a free trial, go to the trial page on MarketChameleon.com, and you'll see we have a 7-day free trial. Just fill out the information needed. With that, everyone, you have a great trading day, and we will see you tomorrow, hopefully. Thank God it's almost Friday. Everyone have a great day. Bye.